Real estate is having a hard time not just in the US but globally. It has slowed down everywhere from Manhattan to Hong Kong. First, they said that the issue was good for housing, a good break after it had been heated for so long. Now the slowdown has extended further than markets and those professionals working in the industry had desired. What they don't understand is that we are late in the cycle, and while there may be growth in some areas, it's difficult to appreciate in an environment where conditions are tightening. We'll see what the future has in store. You came here for the truth, so let me unveil that for you. Today we're going to look at real estate from Manhattan to Hong Kong. Let's begin. I wanted to touch on this point first because it really signifies what we can see happening in every market today. Jim, Bear Stearns, Kramer, be careful about how much you sell at these levels. And of course, what he's talking about is not to sell your stocks because you've made some profit here. The long-term trend is bullish. And this is an individual who is obviously being paid off to be bullish. If you remember, just a few weeks ago, he was starting to yell and scream and say the Fed is causing the next recession. We're in a bear market. Oh my goodness, how could they do this to us? And then a few weeks later, we see this type of news that everything is just fine and dandy. Changes his mind very, very often. But that really leads us into the real estate problems that we face today. The same issues here are that interest rates have remained so low for so long. This has created bubbles in places like real estate in Seattle, Manhattan, San Francisco, Las Vegas, and so many other cities. Just in the US, imagine how many around the world are affected by ultra low interest rates in their respective countries. So that brings me to this. The unusually large drop in home sales has real estate agents baffled. Real estate brokers are trying to figure out why sales of existing homes plunged in December. It actually went down 4.6%. Unusually large. You don't see that happening. It's always 0 point and then you would have a number there in the event that it goes up or down. But a 4.6% drop definitely signifies something is wrong. In fact, the shift was one of the largest that didn't involve some sort of change in government policy like the homebuyer tax credit. That's how significant it was. We'll see what the next month data brings to us, and of course I will have that for you. You can see the existing home sales month over month going down to levels we haven't seen since 2015. This shows the family houses sold annual total, existing home sales, pending home sales. All of these have been declining since the beginning of 2018. This is absolutely rattling the market for many people who are real estate agents. You've got the people who are lending the money, whether it's a bank or mortgage brokers. You've got all sorts of lending that's involved there. You have the construction workers. You have the corporations that are involved. There's so many different levels to real estate, and in the US it makes up a large percentage of the jobs, not as much as a place like Canada, for example, but definitely you see this as becoming a future problem. There is no doubt about it. When so much emphasis is put onto real estate going ever higher, it's obviously giving us an issue today. Existing home sales year over year, you could see on the chart moving back into a level that we haven't seen since 2011 on the year over year percentage basis. That's not good, okay? We have very low interest rates still. And what's on top of all of this is the fact that interest rates, mortgage rates specifically, have declined in December. So they should have received a boost. They should have had more sales, but that did not happen. So something's going on here. People are worried, people are concerned. They're starting to just say, let me just see what happens. But that happened all throughout 2018. People were saying, let me just see what happens. Let me see what happens. And of course, in general, interest rates have been rising. This right here tells us that, as we saw with Canada, the commercial banks have to give incentives. And so they're willing to cut from their profit from the central bank to the money that they're loaning out. Of course, they have that spread. And so they can squeeze it down, take some of that, and it may incentivize individuals to take out these hefty mortgages. U.S. home sales cratered in December, causing price growth to slip to the lowest level in more than 6 years as the housing sector ended 2018 on a decidedly weak note. This goes, of course, for equities as well. Looking ahead to 2019, expect weaker existing home sales as the new year ushered in a government shutdown and worsening economic uncertainty. They get into the more details over here. You're seeing the inventories building up in the United States and Canada and many other places around the world like Australia. Look at Sydney, Australia. Look at these other cities in Australia as well. They're basically all following in the same path for the most part. As you can see, they accelerated so high on the way up and they're gonna have problems on the way down. That's usually the way it works. The bigger they are, the harder they fall. This is an excellent article out of Bloomberg. Home prices are dropping all over New York City. So they have some info in the paragraphs here, but if you'd like to see it for yourself, you can go down and actually see this interactive map so you could break it down further, and that might give you an idea of the situation you might be in, or perhaps you're looking into it or you're just interested. Either way, this will give you a complete breakdown of exactly what's happening. So you could see Manhattan, Brooklyn, and Queens real estate at a glance for the quarter ending 2018 at the end of the year there. So you'll see that there's a median home price of $645,000, 4% up from the year prior. But I think it's really interesting to see it at this level, because if you just take Manhattan as a whole or just San Francisco, you're not getting a good enough picture. It's not detailed enough. But when we're speaking in generalities, it's okay to say that yes, prices are very high in Manhattan, prices are very high in San Francisco. But when we want to get more into detail, you have to look at it in an interactive chart like this. So this is for you to check out. There's some more charts if you want to see, but basically the trend is very, very similar in many cities around the world today. Inventory is building up, sales are slowing down, and now prices are falling. Okay, that doesn't apply to every single city and in every single neighborhood around, of course not, but that's the general consensus that we are seeing. With New York City apartments selling for less, urbanites pining for a suburban home in Greenwich might have to daydream a bit longer. In the last 3 months of 2018, purchases of single-family homes in the Connecticut town slipped 2.2% from a year earlier, the first decline in 3 quarters. So you're seeing this happening not just in one area, this is spreading out everywhere. This is a 17% drop. That is so significant. It is actually quite extreme when you see it over that short period of time. The weakness in New York City has definitely played a role in some of the weakness that we felt here. So they're talking about Greenwich, obviously, and this just tells us what we are seeing in many other areas as well. Many people are coming from Manhattan, where the median home price is below $1 million for the first time in 3 years. And that is supposed to be exciting for some people. Finally, it's under $1 million. Well, that doesn't really give a lot of people hope when they're making the average salary. If the average household income is, let's say, $80,000, maybe it's $90,000. Well, it's not going to be enough to buy that $1 million average home. Average salary, average home, they don't correlate today. That is especially obvious inside of Manhattan, inside of New York, in San Francisco, many areas of California, many cities in Australia and Canada, and so many places in Europe as well. And now I'd like to talk about some other issues, some economic factors here. Americans are not feeling very confident about the economy these days. Almost half, 48% of Americans say that economic conditions are worsening. That's up from 45% in December and 36% in November. That's according to Gallup. Now, what we're seeing is complete correlation to the data that we've been pulling up all throughout October through the end of the year up until now. The economy doesn't look good, and neither do the markets, and that should be worrisome to many individuals out there who are relying heavily on what happens within these markets. Whether it's housing, whether it's equities, it doesn't matter, because this cannot continue forever. And if there's a slowdown for any reason, and that might very well put a huge burden onto people, whether that means we're going to see higher interest rates, maybe that's going to be somebody losing their job. There are so many different reasons why this could be an issue. Global policy uncertainty stands at record levels. So you'll see this here is just provided by Goldman Sachs. Global Economic Policy Uncertainty Index, you're seeing this at an excessive high today. In fact, ever since the financial crisis, it has basically been climbing. There has been no stop in uncertainty. And you can agree with that we have seen a time in which the central banks have been controlling the markets. They know exactly what they're doing at all times. They make it seem like they're just sitting in the background waiting for the data. However, they are making the moves. And here you can see what's happening in reality is that investors are uncertain, consumers are uncertain, and that has been a problem, especially in 2018. And last but not least, this post on Twitter was very interesting to me, and it has that nice chart at the bottom. QE infinity is all the talk in Davos at the World Economic Forum. Bridgewater's Dalio says monetary policy will be easier than factored into markets. UBS's Weber says that normalizing rates this cycle is mission aborted. The G3 balance sheets and the MSCI World Index move in lockstep. And this is a chart that I like to show as often as possible. You're looking at the balance sheets of the Fed, the BOJ, and the ECB mirrored with the MSCI World Index. And my goodness, how accurate it is. I would like to see a more broad chart. In fact, when you can actually add in other central banks, it becomes even more telling. Okay, so that right there just gives us a little peek, a little peering into what we can tell is extremely important that central banks are controlling this. They brought interest rates down all the way. They printed the money. They bailed out all these institutions. And now we have a problem. Still today, a decade later, the problems have not been resolved. You're seeing the imbalances that have been created. The central banks printed money. They're looking for interest rates in this so-called inflation rate that is entirely fraudulent. The inflation doesn't necessarily come up in that statistic. It can end up anywhere. It could end up absolutely anywhere. It could be FANG stocks, for example. It can be real estate in Las Vegas, Seattle, Manhattan, San Francisco, Toronto, Vancouver, and all places around the world. Okay, that's not the way that it works, that they tell us, that it's just going to end up in this fake inflation number. No, central banks print money. It ends up going all around the world. It's sloshing around in these financial markets, and there's no telling where it's going to be. We have seen from 2009 up until present day that obviously equities have been the benefactor, particularly FANG stocks, and then also real estate. And I could just go on forever, but you know what I'm saying. That's all for this video. If you found it informative, please give me a thumbs up. If this is truly helpful to you, if you learned even one piece of good information from this, hit that like button because it really does support the channel. If you want to know how it supports the channel, many people ask. Basically, it helps to push the video higher up in the search rankings. Okay, so every piece of engagement, thumbs up, thumbs down, comments, anything that you do helps to push this up higher. So I do appreciate that. Again, last but not least, if you want the financial education that you were not taught in school, these two books have everything that you need. I mean, we're looking at everything from the foundation, the history, the asset classes, tax incentives, reducing your expenses, so much more. Check them out at the link in the description if you want the audiobook version that's available at themoneygps.com.